Stocks. So, you want to invest in stocks. When you buy the stock of a company, you're effectively buying an ownership share in that company. Stocks can generate income for shareholders in two ways. The first is through price appreciation, which is where the stock price increases and the shareholder can then sell the stock for a profit. For example, you buy a share of Apple for $100 and then sell it for $150 later, you now have a $50 gain from the appreciation. The second way is via a dividend. This is where the company will pay each shareholder a percentage of its profits based on each share that one owns. For example, Apple paid a 23 cents per share owned for the quarter ending 4/30/22. Now, most investors own what's called common stock. Common stock comes with voting rights and may pay investors dividends. However, there are other kinds of stocks, including preferred stocks, which work a little bit differently. When you own stock, you essentially own a share in the company's profits and losses. The goal is for the value of the company to go up while you're a shareholder, which will be reflected in the stock price. While stocks overall have a high history of returns, they also come with risk. It's entirely possible that a stock in your portfolio will go down in value, but it can never go lower than zero. Stock prices fluctuate for a variety of reasons, from overall market volatility to company-specific events like a government investigation or a product recall. Generally speaking, over the long term, the average annual stock market return is approximately 7% to 10%. For perspective, an average of a 10% return means it's going to take you 7.3 years to double your money. Investing in individual stocks is for people that have higher tolerance for risk. If you want something that has less risk, but you want to own stocks, then you should look into investing in a mutual fund or an ETF.